Hi, students. This is our first week, and the first week we're going to talk about the origin of money and the role of finance. So why we need money and how the financial market integrated in money. Because we know crypto is a medium of exchange. I'm Yusuf Bonaparte, Associate Professor in Finance, Director. I work for Janus Henderson Research doing. Let's talk about the outline of the this week. So we're gonna start week one, the origin of money and the role of finance. I'll go through the slides quickly. That's my way of doing business. And if you have a question, always you can feel free to email me. The history of money, from where the money story came, the role of money and key characteristic, medium of exchange versus method of exchange. This is what makes an entry for crypto, which is a difference between medium and method of exchange. Usually, when people talk about it, they mix it together as the same thing, but it's not. Ledgers and payments, money supply, and we're going to compare crypto money supply versus the Federal Reserve money supply. Role of finance, which is a price in money and risk. Financial institution, you need to know what institution we have. Obviously, the top is the Federal Reserve. And what type of risk we have. Then we're going to finish with the interconnection between finance and technology. And this is important. Why? Because this is a technology class. This is a technology class. So we're going to see how technology support finance. We're going to finish here. Next week, we're going to talk about blockchain technology for 3 weeks. We're going to have 3 weeks of technology. So the history of money and the role of money. The word money came from a French word, actually, manier. I maybe have accent. And in William Webster, they call it the meaning of word money is something generally accepted as a medium of exchange, measure of value, or means of payment. So the history of money is, that's a history we have, the barter system, commodity money, barter system. I give you eggs, you give me tomato, I give you meat, you teach me finance. Commodity finance, commodity money, stone, silver, gold. And then representative money, which is the gold standard and fiat money. We're going to talk about when we go to representative money, we got to talk about also the gold standard and the fiat money. So the history of money's first step is barter system. It's a Roman word. And the idea is, as I said before, is bilateral. I give you eggs and you cut my hair. My grandmother told me she was giving 4 eggs to the barber shop to cut the hair of one of my uncles and my dad. So back then there is no liquidity in the market and very little liquidity. And then I give you something, you give me something back. Trades between countries. India gives spices. We're very famous with spices. And then the Holland used to give them sheep and cattle. So that's the way it works. Step 2, commodity money. We're talking about, it starts with the shells, like a stone in Africa. They have a black, unique stone, very unique. So I give you, so how much this tomato? 1 stone. How much this agriculture stuff? 2 stones, 3 stones, 1 stone. So they have a black stone that they use it as a shells, also the shells, as a measure to do trade. Now, why did they use commodity like shells? Because it was limited. The supply of shells was limited. And that unique, not everybody can have it. Step 3 is representative money, which is the money we know it now. And we have one of its paper money. And it has a long story, the paper money, but the most acknowledged one and most recent is in 1661. They issue banknotes when the banks start be involved. Paper money before 1661, but banknotes become to be in 1661. And then the gold standard is monetary system for which paper notes were a medium of exchange and were convertible into preset fixed quantity of gold. That's another way to do it. Toward the beginning of the 20th century, like in 1900s, most countries adopted the gold standard back in their legal tender notes with the given quantity of gold. Now this is important. This is important. This is very important to understand why the United States dominates the world. Why the United States dominates the world. So it's nothing to do with the US Army or Navy or Marines, which is great. These are great things, not bad. And we have a 750 bases across the countries. That's even wonderful. But that's not what make America control the world and dominating the world. The reason the US dominated the world is World War II. World War II, you have Eastern Europe, Russia, Ukraine now. Back then, there is no Ukraine, and Poland. And they have a Germany, Central Europe, and Austria, and Italy. And then you have Western Europe. Italy is also Western Europe, part of West. France, UK, and the other, Spain, and other countries. So what happened is this took the East and the West, smash each other. Paris was down. London was down. Berlin was down. Moscow, St. Petersburg, Warsaw in Poland, everything destroyed in this war. Everybody lost World War II. The German lost more. So as a result, the only country was not damaged, the United States. So the United States did a Marshall Project, where they rebuild Europe, the US. In return, these countries start buying American dollar and using the American dollar as a medium of exchange. And then when these countries want to come back again, they need to have a reserve. So what they did, they sent gold to the United States, and in New York, 1/4 of the gold, 1/4 is in New York now. So, and the US created what called the IMF and the World Bank, and then the US was dominating the world because they rebuilt the world. And when I say the world, I'm talking about Europe. But you can tell me, Yosef, what about Asia and Africa? Well, Asia was nothing. China was not like today. Africa was bad and still bad, unfortunately. And there are reasons why Africa bad. One of the key reasons is geopolitical problem there, and that's a different topic. So, so what happened is US say, okay, we build your economy, you give us gold, and we put in New York as a reserve for your currency. And that's a gold standard. And the US started printing dollars based on the gold that they have. But in 1971, we didn't have enough gold. Nixon has to stop doing the gold standard. And he said, okay, now we're going to print dollar even if there is no gold. And that means we're going back to dollar standard in the world. And here's some story about the IMF. Now we're going to go to the role of money and key characteristic. There are two main roles for money, many roles, but the key are store of value. Like, for example, you want to go to college next summer. Well, you need to save money, and you put this money, you store it in value, and in the summer when it comes, you pay tuition. And then unit of account. You want to go buy McDonald's. How much the burger? $2, $3. Okay, so you need how much a burger? Somebody has to tell you something. Like in United States, American dollar. In Canada, Canadian dollar. In Mexico, peso. So I'm sorry, I have accent. I might not say the concept properly. My apologies. In China, yuan, in Japan, yen, and in Europe, euro. So unit of exchange, a unit of account. The greater role of money is a medium of exchange between two parties who are interested in conducting transaction or a trade. Now, medium versus method of exchange. This is critical because this what caused crypto to come. Crypto came for other reasons. Has to do with George Bush in 2008, 2007 and 8, when he doesn't, and the Federal Reserve, when they don't want to have liquidity in the economy, add liquidity. That was one of the reasons, but that's another reason. We'll talk about that later when we go to crypto, the current and the future. Medium of exchange versus method of exchange. Now, if you go to King Super, and we are in Colorado, so you buy your basket of grocery and other things, and you can pay either cash or credit card or writing a check. For Costco, I think these are the three things. Maybe there are other things. Now, credit card, you have a PayPal, MasterCard, Visa, all of those. Discover and others. So the medium of exchange is American dollar. Like this basket worth $60, $70. So unit of account, it has to be with the dollars. You cannot say in King Super, well, how much is my basket in Canadian dollar or in Mexican peso? No, it has to be American unit dollar. Now, the method of exchange is varying. You can pay cash, you can pay with a credit card, you can pay with a check. So the method of exchange varies, and that makes a difference. Before the credit card era, which is I think in the 40s or in the 50s, the credit card started. In the 80s, it became to be a big mass in 70s, but in the 40s or 50s, back then we had the medium and the method of exchange are the same, which is $1. This basket costs $60, and I will give you $60 cash, no check, no nothing. But now, because the checks came and the credit cards, the method of exchange has changed, and that's what opened the story for crypto, that you can have a coin that changed the medium of exchange and the method of exchange. For example, when you go to a cost King Super, they can tell you its unit of exchange is $60. But if crypto become to be more mainstream, then they can tell you it's $60 or 40 Bitcoin or 30 Ether, whatever is your basket. So that would be the word that we're looking for. So there are three categories of medium and method of exchange: dollar decentralized medium and method of exchange, dollar decentralized medium and method of exchange. What is that? Centralized and decentralized. And that's the story of DeFi, what we call DeFi finance. DeFi finance is peer-to-peer, like King Super said, your basket $60, I give them $60. That's peer-to-peer, because between the seller is King Super, the buyer is me, I'm give them the money, exchange $60, that's a peer-to-peer. Now, if I use the credit card, Visa, MasterCard, whatever it is, then it becomes to be a centralized medium and method of exchange. What does that mean? When I buy a basket from King Super, say $60, and I give a swipe the credit card, in theory, King Super sold the product to Visa, because Visa is going to give them the money. And I bought from King Super. No, I bought from Visa. Visa gave me the basket, and I give the money to Visa. And this is a system of trust. What does that mean, system of trust? Centralized equal trust. That when you buy the product from King Super and you slide the Visa and the Visa approve you, that means Visa says, trust me, this person can take the products. And if that person has a problem, it's with me. Trust me, I am Visa. I will pay you the money. Give them the basket, let that person go. I'll give you the money, even if that person doesn't have the money. So it's a trust system. The centralized is a trust. If you send a check for Wells Fargo, for example, I have Wells Fargo account, for example. I don't use a check, but if you use a check and you give them a check, that means a trust. That Wells Fargo is saying, even if this person doesn't give you the money, trust me, I'll give you the money. Let him go. Let me go, Yosef. But if let her go, or him, let him go. So centralized means it has to be a third party, either the bank, credit card, or others. Decentralized, the bank or Visa or MasterCard are out of the story, out of the transaction, the buyer and the seller. The seller give the good, the buyer give the cash. So cryptocurrency is a decentralized medium and method of exchange. In the cryptocurrency is a technology, comes from a technology called blockchain. Blockchain is a place where the buyers and the seller sitting there. And if Bob, when I send money to Sarah, then Bob send the Sarah directly, peer-to-peer, decentralized, not centralized. Not Bob send it to Visa, Visa send it to Sarah. So crypto is a blockchain that all the buyers and the sellers are there, and the transaction between any two people in the blockchain is peer-to-peer. Ledger and payment, I'll go quickly through those. It's just accounting system for a company making a lot of payments to customers and to suppliers and some cash from customers. So they have a ledger and payment system. Ledger and payment system, here is example. Say company like ABC buys material for 1,000, a debit of 1,000 recorded to their cash account, and a credit of 1,000 is recorded to the inventory account. So this is pure accounting. And here we talk about ATM, SWIFT between countries, ATM between if you live in the United States, we have an ATM machines. Now we're gonna talk about the money supply and compare it with the crypto. The money supply is determined by the Federal Reserve. The Federal Reserve has two goals: low unemployment between 3 to 4.5%, and low inflation at 2 to 2.5. These two laws are not going together. They're going in the opposite direction. Why? Because to lower the unemployment, you need to print money and give it to people. When people get the money, loans and mortgage and things like that, they start buying. When they start buying, there's inflation. The demand increases, there's inflation. But when you start buying, a lot of people got jobs because the businesses are doing good to start hiring people. Hiring people, giving more salary to workers, workers get money, start buying, inflation going up. So these are going in the opposite direction. And by the way, the Federal Reserve increased the money supply from the bond. When the Federal Reserve sell bond, that means they get cash from the people, then the money supply decline. When the Federal Reserve buy bonds, suppose there's $1 trillion of bond in the market, and the Federal Reserve go put $1 trillion and take these bonds and paper money, paper notes, then you put $1 trillion, that means increase the money supply. The Federal Reserve does it through a bond market, but also does it through banks. They give them money and they ask them for a lower rate so the banks can take more money, or they can ask them to lower the residual in their like they can tell the banks, hey, lower your residual of minimum cash in the safe and give it to people. When you lower the residual, banks will have extra cash, give it to people. I'm going to go quick here, but we're going to talk about it later more. Comparison between the money supply between Federal Reserve and cryptocurrency. Cryptocurrency, that's a key one, is self-governed technology. So in Bitcoin, depends on the transaction, the money supply of Bitcoin be determined. In the real in current world, what we have now, it's a decision by a one man, Joe Paul. He can say how much money supply. He has advisory board, but their advisory, the only advisory. They cannot. It's not a democracy. 6 said yes, 7 said no. No, they advise the chairman what to do, and he decides. In this case, Joe Paul. Before him, she was Yellen. She was deciding. So it's a one man show. Here with the crypto is a technology. The technology based in a transaction. Here's the money supply story for Bitcoin. There's a lot of information. You didn't know it because you didn't know blockchain technology. When we go later on, we'll talk about it. And here's the supply side for Ethereum. Here are a few pictures about the old money tokens. This is a wood sticks. Wood sticks usually used to do it as a measure of like this stick equal $1,000, for example. And if you own it, that means it's worth $1,000. Now, back then there is no dollar, but it's worth something like 1,000. Now you can say, Yosef, I can replicate that. You can say, oh, I can replicate that. Bring a wood, make it these colors. No, because they're gonna break this stick. One is stay in the government and one taken to you. And when you want to say, okay, this has a value, you have government has to say, make sure it meets the other side of it. So they break it 2 pieces and give you 1 piece. And here are some other examples. Now, here's the first homework for you, lecture homework. Let me talk about it. The idea of the homework is to make sure that you watch a video and you read the slides. So here are the questions. I like short and sweet. Some answer could be 1 line, some answer could be 2 sentences, or 1 sentence, or 2 sentences, or 1 paragraph. I see this, usually the homework should be 1 to 1.5 pages maximum, top. I like short and sweet. I don't like a lot of things, but go ahead. You want to write more, I will read it. I'll be happy. But I like short and sweet. Chapter 2, the role of finance. I'll go through that too. And that will be the end of this week. The role of finance is the price of money and risk. That's it. This financial market, Wall Street, and all of this, all but their job is to price in money and risk. For example, if you have if you want to buy a share of Apple, how much the price has to be for Apple? So that's a financial market told you, oh, here's the price, and the fluctuation give you the risk of Apple. Also, the financial help to facilitate and move in allocation and pricing of asset. Facilitate means facilitation means that the financial market provide a place where buyers and sellers meet. Now, NASDAQ is an exchange system, the NASDAQ. So buyer and seller can meet and trade securities. Now we have internet. Before the internet, it was a big floor, and people come in and start doing like this, a quarter, half, or this, half, or quarter, and they try to give signs, I want to buy that much shares, and done by a place back in the days, I'm talking about till the 90s, before the internet. It was a place. Now it's through the internet. Pricing and risk, that's the role of finance. So the listed price reflect the available information now. But why the price fluctuate? Because analyzing the information could be, some people say it a good information, some people bad. Also, the reason for volatility is we have a 24/7 news cycle, and buyers don't know all the information, because gathering information, even if it's available, gathering the information is costly. Type of risk, there are 3 risks. Global instability or crisis and instability. The other one is like war in Ukraine, Russia. What if tomorrow China and Taiwan have a war? Then all the semiconductor, price of NVIDIA will go down, definitely. There is a risk associated with fiat money instabilities connected with if the Federal Reserve inject a lot of money in the market or not, and the risk of financial inclusion. Now I'm going to talk about financial institution. There are many institutions. The biggest one is the Federal Reserve. The Federal Reserve gives liquidity, price the interest rate, the Federal Reserve, and also oversights bank, the Federal Reserve. So it has a regulatory oversight and control for interest rate and money supply. There are other things. The mortgage also involved with it, and other things involved. The key financial, I talked about the role of Federal Reserve role. So there are this other financial institutions are banks, credit unions, saving institution, commercial banks. There are investment banks like Staple, brokerage and security firms like Robinhood and Vasco. There is a credit card companies like Visa and MasterCard. So there's a lot of financial institutions. I'm going to talk about a little bit about fiat currency, central banking, and a credit card. Fiat currency is represented by the central bank, not the government, not Joe Biden. We are 22 now. Joe Biden doesn't print money. If Joe Biden want to spend more money on army or highways, what Joe Biden can do, he can go to the market and sell bonds, notes, and get the money. Now, Joe Biden doesn't print money because FDR, who was the president from 1931 or 32 till 1945 through World War II, he said, we're going to take the money. He started with the process to take the money supply from the government to the Federal Reserve. The first central bank, by the way, it's in France, done by Napoleon Bonaparte. The whole idea of central bank is very recent, maybe 100 years, less than 100 years. The way that we see the Federal Reserve Bank now, that control and this, it's not very long ago. And then we talk about system of ledgers, how the Federal Reserve work. And I'm going to talk about that. When we talk money, people talk about time is money. So here I explain from where this story came. But the whole idea is the time must be converted into a tradable value. The tradable value is to be in the form of goods, such as trading corn for labs. So when you say time money, that means if I have to spend time with you, that means I need to give up doing this, that. So that's opportunity cost for my time. How money maintains its value? First of all, money maintains its value must have certain characteristics: durability, portability, and divisibility. And the key thing for money to hold its value is supply. The more your government print money, when I say government, I mean central banks. Now, in some countries, central bank still controlled by government. In a lot of countries still doing that. And we talk about Africa. This is one of the problems in Africa, is the central banks are not independent. So the more the government print people money and give it to people so they can go buy, not complain about the government, give it to their workers, the inflation going up, and then the money loses its value. Then they cry again, then the government print more money and give it to the people again. Then the inflation going up again, and people, the value that they have become to be less value. So to maintain money, you have to control the supply. The supply of money has been determined by GDP growth and labor market growth. There are other reasons, other things to determine the money supply, but these are the two things: how much economy produced and how much population is growing. Because the more population is growing, they need more liquidity, so they can go and buy on this. And then the more the economy growing, then the economy need to liquidate. So, but if the opposite, if the economy is shrinking, then there's a problem. Finance and technology, and that the end of this week and the beginning for next week. We lay the ground of technology and finance because, as I said, this is a technology class, and next 3 weeks we're going to talk about only technology called the blockchain. And you must know blockchain technology. This technology is very new, very recent, started in 2007. The engineering way before, but become to be relevant in 2007 and 8 and 2010. Bitcoin adopted, and blockchain technology is the future, obviously. DeFi, decentralized finance, blockchain technology, these are two for the future. So you need to know that. So finance and technology is the end of this chapter that opens up the next week's story about lectures about blockchain. And we're going to have 3 weeks for blockchain. The first 2 weeks, definitions, information. The third week is more explain how blockchain support crypto, and we're going to use it Bitcoin. Finance and technology. The finance sector and technology is important, the relationship, and we need technology for scalability and efficiency. Scalability. Like Costco has 100 customers every day. What if Costco has 1,000 customers every day? So can the system, technology system, scale up and have no problem? The second issue is security and privacy. Can the technology secure my wealth, secure my asset, and nobody can go through it and steal my money? So security and privacy are the key. And first is scalability and efficiency, how to make the transaction between buyer and seller. And the second is security and privacy. These are the two roles for technology in finance. Now, the third one is intertradable. The fourth one is governance and commercial use. And the fourth one is public policy and legal structure. But these two things are the most important. The other three are the other things that technology help finance. So the issue will be dealt with later as a Congress find the path to regulate. So now the problem, the breakthrough in crypto will be only after the government regulate cryptocurrency. As of now, it's not regulated. As a result, only the people who own crypto are retail investors, which is me, you, and others. But the big money is with the institutional investors. So we need a public policy and legal structure. When that's happened, then institutional investors, they have the most money in the market, then will be involved. Then crypto will have a big breakthrough. Here are the list of technology of our generation that support finance: artificial intelligence, AI, machine learning, and blockchain. We're not going to talk about these two. I'm not saying these are not important, very important, but we're going to talk about blockchain, cloud technologies used money by companies such as Google or YouTube, and now Visa a month ago, late to 22, Visa start using a blockchain in their system. Artificial intelligence and machine learning is in my book. You can read more about it, but our focus will be in a blockchain. List of technology of our generation. Also, we have API and chatbot. Yeah. Here is example of AI, blockchain, that's cloud, open API, mobile, and other pictures. Now, here are the questions for this chapter. And that will be the end of week 1. Again, you take this question, you answer them short and sweet. It could be one paragraph, it could be one line, one sentence. I just want to see that you answer this question and you watch the video. Thank you so much. And that's the end of this week. Next week, we're going to start with the blockchain. What is that blockchain? How we use it? And key definition. Then we're going to talk about blockchain sectors. Thank you.